I first realized that Bitcoin was digital capital, but you know, digital capital is like, it's like you got a 3-year-old kid and you give him $1 million worth of real estate in the middle of Brickell. It's dirt, no cash flows. And in 30 years, maybe it'll be worth a lot of money. And if you want to get cash flows out of it, you got to form a real estate development company. You got to design a building, get a construction loan, build the building, market the building, rent out the building, deal with all the politics and the maintenance, and then maybe you get some cash flows. But not easy for a 3-year-old kid. Not easy for most 30 years old. So if you go to the same kid and you say, or the parent, you say, I'll just give you a credit instrument that pays you $10,000 a month forever, starting now. Okay, well, how many people would prefer to have the credit, right? By the way, the world is, even if the capital asset's going up 30% a year, the better deal is take the capital asset, but most of the people, like, they can't wait 20 years or 30 years with no cash flow. They want the money. So it turns out that converting capital into credit, that is the mission of the company, in the same way that a real estate developer takes a bunch of raw land and turns it into a building, and either the people are living in the building or the person that's collecting the rents is getting paid some steady income. We realize that we're kind of put here to create that digital credit, and that digital credit is then the stepping stone to the final thing. And the final thing is digital money. And the idea of digital money is not 10% dividend yield with a 10 vol. It's 8 or 7% yield with a 0 vol, right? What if I give you a bank account that pays you 7 or 8% with 0 vol? You put $99.71 in, you get $99.71 out, but until you take the money out, you get 4% more than the risk-free rate and the currency that you live in, right? That is the perfect product. I submit to you, I used to think the iPhone was the perfect product, but the iPhone, you got to actually be able to hold it and look at it, and you got to be awake, or maybe be able to hear, or be able to see. But you know, a bank account that pays you 8% or 7%, you could be deaf, dumb, blind, in a coma, unborn child. You still want that. You want that for your heirs not born for 20 years, right? So what is it that everybody on Earth wants, right? And you know, in the English language, there's a word for what everybody on Earth wants, for universal utility, and the word is money, right? You want money, okay? When I give you a bank account that pays you double what SOFR pays you, if I give you double the money market, or if I give you, you live in Japan and I give you 6% or 8% in yen, I'm literally just giving you free money, okay? I know it sounds difficult. It is difficult. It's like building nuclear reactors in order to give you free electricity or 1 penny a kilowatt hour electricity. It's hard, right? You basically have to create a layer of digital capital, not our doing. Then you have to create a layer of digital credit. It takes a lot of equity capital, right? We have 60 billion now. We'll probably have the most digital equity capital in the world forever at this point, because no one's going to catch us on this network. And if you have that credit layer, the last layer, digital money, can be created by partnering with a bank or a money manager. Like, you just basically go to a large bank or a BlackRock or a Vanguard or the likes, and then you create 80% credit, 20% cash equivalents, put a 10% buffer of currency reserves on top of it to strip the last vol each day. And you have just put shock absorbers on the credit, and the credit is, of course, sort of like damped, volatility stripped, risk stripped capital, right? And that's the 3-step process. So the day I realized why I was here is, I realized we're here to fix the money, right? We're here to give 1 billion people a bank account that pays them 8%, when the rest of the world wants them to take nothing. Right? In Switzerland, nothing, right? In Japan, nothing. In Europe, 1%. In the US, about to be 2.5%. When the Fed lowers SOFR to a 2 handle or something, you will be getting 2%. And the actual increase in the monetary system is like 7% a year for 100 years. So if you don't beat 7%, you're just getting poorer in relative basis. And right now, the only way for the average person to beat that is to gamble. You have to gamble on equity. You have to guess. And I'm of the opinion, when you're a 70-year-old retiree, you shouldn't have to gamble. You shouldn't have to gamble on equity. It's not right, right? The entire world somehow decided that capital was buying the S&P index, right? You have to buy a portfolio of equities. And what about just giving people a savings account that actually preserves their wealth and they don't have to gamble on equities or the like? And so that's what we're here for, right? We're digitally transforming the credit markets, but the big idea is fix the money in the world and fix the money with technology. You give someone a bank account that pays 8% backed by digital capital, what happens? You slurp $20 trillion into your bank. By the way, that second idea, have the bank custody Bitcoin, that's a good idea for crypto billionaires. The crypto billionaires send their money to UAE because now they can get a loan at SOFR plus 50 basis points on their Bitcoin. That's a good idea for crypto billionaires. The third idea, digital money account that pays 8%, that's every billionaire, right? That's just everybody, even the people that hate Bitcoin, even the people that don't know what it is, everybody with money, small, mid-size, large, it's a bank account that pays you 8%. What do? I'm just going to wire you billions and billions of dollars, of actual dollars, from Australia and Canada and Singapore. And if the Chinese would let me, I would wire it out of China, but they won't let me. But it will flow from every market where there isn't a capital control into the bank. And so what did I tell them? I told them, you want to be the Switzerland of the 21st century. Switzerland's not going to be the Switzerland of the 21st century. They've already missed it, right? If you want to be the banking capital of the world in the 20th century and draw tens of trillions or hundreds of trillions of dollars eventually into your country. And I said, you don't want the people, you just want the money. Right? Like think about this for a second, right? If you could just have all the money of 1 billion people come to your country and the people left behind, you're better off. That's the idea, right? Don't draw the human capital, just draw the capital. And the way to draw the crypto capital is create crypto credit, you custody Bitcoin. The way to draw all the capital is create digital money. Right? It's like, you know how to operate airplanes. I'm afraid of them. There's a fire in the jet engine, right? It's a fire. You know how to operate nuclear reactors. No one really. They don't care that they don't know how to refine crude oil or create explosives or build airplanes. They don't care. All they know is the United States is the most powerful country on earth, and so therefore they trust us with their money. And so this is an arms race for the future of money. I don't really know who will win it, but my money is somewhere between the UAE and the USA. Believe it or not, the USA was behind regressive and getting worse 15 months ago, and we have flipped. And so, it's not clear to me that one USA bank won't get there first. You have a very supportive head of the SEC. You have a very supportive head of the CFTC. You have a very supportive head of the Treasury and the banking apparatus in the United States. Between those three, I don't think there have been three more progressive regulators working for a more progressive president in the century, right? Not in a long time. So the U.S. definitely has a fighting chance, but Abu Dhabi's got a lot of very aggressive people. They like digital technology. They like money. And they know that there's no way. By the way, if you go to Abu Dhabi and you go to the top floor of ADIA and you look down, the Sovereign Wealth Fund, and you look down, they're building Manhattan in the desert. Their aspiration is to build Manhattan in the desert, and they know you're not going to do it without a lot of money and without taking risk and being progressive. You're not. Other places, they don't feel the need. I think the Europeans feel like they've already got it covered. They're all fine, right? And others don't feel the need. But in UAE, actually, they have ambition and they know that they can't play it safe. They're going to have to embrace new ideas. I think that they're the first city talking seriously about licensing air taxis.
Wow. Do you think Bitcoin's 4-year cycle is dead?
I think it has its origins in the fact that, Satoshi implemented the halving. 50% of all the Bitcoin that will ever exist was mined in the first 4 years. And then there was a halving, and then 25% came in the next 4 years. And then there was a halving, and then 12.5% came. So one can certainly argue for the first 12 years, it was supply driven because the amount of Bitcoin being put on the market was large by the miners. And then each halving event cut that supply in half, and then it went to 6.25, whatever, and then it went to 3 1/8 or something. And so we're at the point right now where it's become somewhere in the range of I would say a second order to a third order driver. The actual liquidity in the market, depending upon your estimates, is like $20 billion to $50 billion are the estimates of daily spot liquidity, and $100 billion of derivatives liquidity a day. The Bitcoin being mined by the natural miners is 450 Bitcoin a day. So at current prices, you're talking about $40 million. So $40 million of supply coming on the market each day versus between $20 billion to $100 billion of trading. It suggests to you that the supply side is not driving the market right now. And if it was, and that's the only argument for the 4-year cycle really, it's being overwhelmed by other structural developments. When, if you think about the annual supply at 450 Bitcoin a day, you're kind of you're in the $16 billion to $18 billion worth of natural Bitcoin from natural sellers available to sell each year. So every time someone buys $16 billion worth of Bitcoin, that's one annual supply. So my company bought more than that. BlackRock's buying more than that. If JP Morgan turns on credit, they will issue $16 billion of credit, and that'll be one more turn. And so if you look at the formation of the credit networks, when the SEC took the handcuffs off of IBIT options, they were crippling the derivatives market for IBIT options on the regulated markets up until like a few months ago. When they first of all, they made it illegal to trade options for 4 years. Then they turned on the spot ETFs, and the spot ETFs grew to $100 billion in like 15 months. Then the options market got to 10 billion, and then in a couple of weeks it went from 10 billion to 50 billion. And so structural things like unhandcuffing or normalizing the options market, turning on, the CFTC just green-lighted native spot Bitcoin trading on the Chicago Mercantile Exchange, right? The CFTC just green-lighted it for regulated exchange in the US. And then they green-lighted the use of Bitcoin as collateral for those transactions. That's going to create 10, 20, 50 billion dollars of increased trading. So the structural changes by the regulators and by the banking and the trading establishment are way overwhelming the 4-year cycle, quote unquote, which is built into the protocol. And so at this point, the thing to be watching is the formation of the credit networks and the formation of the capital networks, and those are all decisions made by the commodities regulators, the securities regulators, the digital assets regulators, the banking regulators, and then watch the action of the big banks. Like Citi announced they're going to start to custody and issue credit on Bitcoin next year. Schwab announced they're going to do it. I think we'll actually see 8 of the 10 largest banks in the US do it in the next 24 months. When they come into the space, they're going to create $100 billion worth of credit each. And so the amount of, let me say it a different way. If you could not get a loan to buy a house in Miami or an apartment in Miami, what would the impact on the price of the real estate be? And if someone said, oh yeah, guess what? Banks are going to start giving you mortgages on houses but not apartments. And then they said, well, apartments, yep. And then they said, well, now it's subsidized and it's going to be a conforming rate 200 basis points lower. Prices go up again. And if you recall, what happened when Jerome Powell said we're lowering interest rates to zero, and the Fed regulators said that the reserve ratio for banks could go to zero and they could, in essence, have unlimited leverage. And they said that in March of 2020. If you recall what happened to real estate prices? Yeah. So it's the credit networks forming and normalizing around this asset, which are going to drive the asset class right now. And it's not the 4-year cycle. There are dynamics, but the dynamics have to do with the credit markets and the actual trading of it and the formation of derivatives and how they move.